How did you guys do on your, how are you guys doing on the assignment?
Finish.
Yeah, homework too.
Finish.
And what did you learn, or if anything? What were the results of your analyses?
Actually, I most of them are in electrical analysis. And there's a compare the difference in Australia from in industry. So it seems that the number of transaction is bigger, so it's going to get more.
Okay, say that again.
I observed that the number of transaction increase, then again increase too. The number of transactions.
But the more transactions you make, the more
More gain.
more gain.
The more transaction including the Amazon and the resource center.
Okay. So in one sense, it would make sense that the more if you have a basically sound activity that you're doing, the more of it you do. And how did it compare to the baselines? Much better? A little bit better? More.
It's trying to perform difference in stable period and stable period. I mean, in the first 5 year and in the second 5 year, they have performed difference.
Right. That would make a lot of sense, okay, that it would depend somewhat upon what period you're doing. Certain strategies, right, let's say that makes a lot of sense. Anything interesting with yours? Way to compliment this. No. Okay? Okay, fair enough. Anything interesting with yours?
I think my simulation models is similar to him, and he is all if I shorten the calculating period, that means for moving average, I shorten the period, it will result in more transaction or more trade.
Right.
Yeah. And so the returns, overall returns is more, but I think that there will be a lot of false points.
Lots of what? Lots of what?
False points.
False.
The points may not be some true to the turning point. Because I use the moving average to be the turning point.
Right.
Yes. But the point needs time to prove it. So generally the points may not be true for exactly for the turning point. If I put the sensitivity or the period, very short period or very high sensitivity, the form, the reliability of the form may not be too good.
Okay. Okay, interesting. Anything interesting that you guys, with your guys' strategies? So we're talking just briefly about the homework. Again, homework 2 is going to be due today. Any comments or questions, or how are your strategies doing? Just to sort of discuss. Do you have any experiences that were interesting?
Still the volatility, the strategy select higher volatility stocks. I checked my strategy and I found that if I select stocks among hundreds of stocks, like 400 stocks, I can always benefit more when I select the more volatility stocks. But
Right.
if we choose with a small set of stocks, like 20 stocks,
Right.
I select just 2 or 3. The top 2 or 3 of the volatility will the curve will fluctuate dramatically.
Okay. What he's talking about is a strategy where you invest in the stocks which have had the highest volatility recently. Okay, and the theory behind that one would be that there's a risk-reward thing. If you have a stock that's fluctuating more rapidly it is presumably a riskier investment, and therefore it would demand a higher return in order for people to take it. And so the argument is there that he's looking at a bunch of highly volatile stocks.
Yes.
And he says if you take enough of them, the averages on average are good.
Yes.
And the reason you probably need to take a bunch of them is because because of the volatility and the risk there. A certain number of these guys go down and bankrupt. Okay, and so you need to sort of somehow diversify away that kind of a risk, and that's sort of the argument there. Anything interesting in your strategy before we get on? And then I promise we'll get started.
The performance is the differentiation is not so great as I expect.
The differentiation
Of different strategy.
Okay, so you're saying all the strategies did about the same thing for you.
Not really. Some are a little bit better, some are not so good.
Okay, so one question we talk about a little bit better, a lot better, of course, is ultimately are things statistically significant.
Yeah, but I believe those little differentiation may be caused by some errors or some inaccuracy of the evaluated solution.
Okay, and you want to blame the simulator. Okay, and that may be a reasonable thing. Let's take a look at this and let's move on now. So what I wanted to talk about today was what they call something called market microstructure. Okay, which if I'll give you a little definition later, but most of what we've been looking at has been at what I will say. Again, at one point when I started talking about trading strategies, I said there were two different kinds of people. There were sort of what I will call the investment managers, who were supposedly making decisions about what it is that you should buy and sell. And then there are the traders whose job it is to somehow to actually do the buying and selling. And once given an order. And the job of the trader is not as routine as it might sound from that kind of a breakdown. So if we think about, let's say, what a trader can do, or when you've actually decided you're going to buy or sell a stock, you have to place some kind of an order. And there are different kinds of orders that you can place. And what happens when you try to buy stock depends upon what kind of an order you put in. And the impact of what these orders are and how you should place these orders gets into what we will call the microstructure of the market. Okay, and it starts to be interesting. So typically when you call up again, I think of it as call up a broker. Presumably these days it means push a button on some kind of an electronic trading screen. Okay, you've got different kinds of things that you can that you can order. One kind of a thing you can do, and none of them exactly correspond to this kind of trading operations we had in homework 2. So we should realize what the difference is. A market order would request that a trade happen immediately at the best current price. It says, I want to buy Microsoft now. Okay? And whatever price it's at, I will pay it. A limit order, okay, is an order that instead says, I will buy or sell Microsoft at this price, okay, but only at this price. Okay? I will sell my Microsoft for $20.03 a share, and if you can't get me $20.03 a share, do not execute this order. Okay? And that's what we would call a limit order. Okay? And there are other let's say variations of this which sometimes turn out to be interesting to execute. One would be what they call a stop order or stop loss order. Says that when the price reaches a particular level, sell it now. Okay? And even if you can't get the price so let's say I put in a stop loss order for Microsoft at $12 a share. Suddenly, Microsoft suddenly announces it's going to, buy General Motors, and its stock plunges. Okay? The moment that price hit the $12 a share that you ordered, at that point, your broker is authorized to sell it at whatever price they can get. Okay? If it's falling slowly enough, that means the price would be $12. but there's no guarantee of it. If the price is in a downfall, okay, it may very well be no one wants to pay that $12 for it. And because you've now put in a market order, you will get the price that is available at that time, triggered somehow by that price. Any questions about what the differences are? Okay? And similarly, a market if touched order is kind of the opposite one for when you're going up. It says that if the price hits, let's say for Microsoft, hits $25, then the order is sell at what you can get now. Okay? And hopefully I'll get the $25. If it keeps going up, maybe I'll get more than that. But regardless, sell at that point. So the way to think about the market if touched order and the stop loss orders are they're sort of just symmetrical things, depending upon one on the upside and one on the downside. But the bigger difference is you can either buy it at the current price, demand a certain price, or use a price as a trigger to go and decide what, basically to buy or sell. Any questions about that? Okay, do people see why there are these three different kinds of orders are all useful, okay, but in different situations, okay, and why they would all be implementable? Some of them guarantee you selling, some of them are buying, some of them guarantee you a price, okay, and I guess some are sort of combinations, okay. Any questions? Yes.
What's the difference between the limit orders and the stop loss order?
So a limit order, okay, is going to. So let's say we have a world where I have a limit order in. Let's say that I have a limit order in, okay, to buy this thing, to sell when it gets to $20, okay. Now suppose the price is jiggling, hits 20 for a moment, okay, but somebody else's stock got sold ahead of mine. Okay? There are a lot of people who may have decided that they wanted to sell stock at 20, right? Let's say that there are, 1,000 shares worth of people who want to buy at 20, and 1,500 shares worth of people who want to sell at 20, right? The price could jiggle up to 20, but you not actually get that price because these other people were in line ahead of you, okay? And now the price jiggles down, okay? Because now there's still more demand to sell at 20. There's more demand on the other side, okay? Now what is the situation? In a market order, if you said, give me a market order now, at whatever time period here, okay? This will then go and match once its order kicks into the right position in the queue, it will be matched with whatever the current price is. Okay? In a limit order, if it hit 20 and bounced down before you got a chance to sell, you wouldn't sell. Okay? And if that was the high peak of the market, you would never sell your stock. If you have a stop loss order, okay, again, I may have gotten buy and sell confused here, okay? I may have changed it midway my example. But if, let's say, this was a market if touch order, the moment it hit 20, you will try to sell, you will put it in the market queue, and then the price may drift before your turn actually comes up, okay? So the limit order guarantees you a price. The market order, in principle, guarantees you that it will sell. Okay? The stop loss order or the market if touch order says that when something happens, put in the market order, as opposed to putting the market order in now. That's my way of thinking about these things. Any questions about it? Okay? And note that none of these actually correspond exactly to what was happening in your simulation. In your simulation, you said, buy it at the opening price, okay? And, or sell it buy or sell at the opening price, or buy and sell at the closing price. None of those are really options here particularly. Because there's a lot of people maybe who want to buy and sell at the close. If you look at, let's say, the volume of transactions that actually happen, okay, most of these transactions happen either at the beginning, the opening, or the closing, okay, and and you could put in a market order. The question of trying to say, if so I have to look a little bit about how things get matched, but the actual thing in the simulation probably could not be implemented. Because you can't sort of say, I want mine to be the last order to be traded that day. Okay? You can only put it in the queue and hope for the best. Any questions? So what's interesting is, if we know something about these stop, what orders, if you think about the orders that are here, there are these limit orders, stop, market if touch, stop, and limit orders that are sitting in the queue. Okay? These, in principle, contain information about future price movements. Okay? They tell you what orders are waiting to execute. And that would be an interesting thing to do. Now, some theoreticians would say, if you put in a order that says, if you put in a limit order and says, I will sell at 20, you're giving somebody else the option to buy from you at 20. Okay? That's really what it says. If you say that I am going to sell at 20, okay, you're giving somebody else the option to buy from you at 20. Okay? And you're giving it to the broker or whoever else you made the order to. And so, in one sense, that may not be good for you as an investor. Because in some sense, you're giving something away which really, in principle, has value. Okay? On the other hand, if you try to, unless you're someone who can monitor what the current price is extremely carefully, okay, so that you could, in principle, say, sell when it hits to 20. If you're monitoring the prices so closely and you can get your order in, boom, the instant it hits 20. Okay? But bottom line, in a world where you can't, and certainly the kind of investors that we would tend to be couldn't do that, some of these other orders make sense. Okay? Any questions? So when people talk about the microstructure of a market, they're talking really about the computational and financial details of trading. Okay? These sort of low-level tradings of what happens with orders being placed. The fact that orders are discrete things, okay, as opposed to these sort of flows that we've been talking about. Any questions? So this is an example of something that I spent a lot of time last night watching. Okay, and it's a lot of fun, actually. So I encourage, unfortunately, let me just check to make sure. I believe the market is closed now. I tried to set this thing up. So the answer is, unfortunately, we can't watch it now. But I encourage you, at the time the United States market is open, to go to a link such as this, okay, and look at the market order book. The market order book is the listing, in some sense, the queues of what orders are sitting, waiting either to be bought, either buy orders or sell orders, okay, that are sitting there waiting for the stock to hit the price that they would want. So this is an order book that I got for Microsoft last night, a little bit before the opening of Microsoft, on this electronic exchange called Archipelago. And what did it show? As of 9:06 in the morning there, in New York, in the morning, it was open. There were people there, there were people there willing to buy Microsoft at $19.89 a share, okay? And there was 1,077 orders for that price in there, okay? There was somebody else who wanted to buy 500 shares at a nickel less than that, okay? Then for pennies less than that, some people wanted to buy it, were willing to buy it. Here is what somebody was willing to pay for it, was willing to sell it for, okay? They had Microsoft share, they had $1,992 shares worth of Microsoft were at that instant sitting and waiting to sell at a price of $19.92. So if these people could buy the stock, if they would raise their price 3 cents, okay? These people could sell their stock if they lowered it 3 cents, okay? If you came in with a market order now and said, I want to buy it, you would be buying it from the person on the top of the queue, okay? And you would pay $19.92. If you said, I want to sell it, you would sell it to the person at the top of the bid queue, okay? At $19.89, okay? And so what's interesting is that this, on many exchanges, like this Archipelago exchange, the top or electronic network that we'll talk about in a second makes its order book public.
You just said that if you want to buy it, buy from the person who wants to sell it for the most, the highest price. That's essentially what it's saying. So why would that be? Should you, if there were people willing to sell at various prices, the lowest price, wouldn't the person who's selling the lowest price?
So the person who wants to sell, okay, let me make sure I'm getting this right. To buy it, okay, let's say there's a bid and an ask price here, right? This is an order that says, I want to buy it, and I'm willing to pay this much. Okay, these are the people who are willing to buy it. And as you notice, the prices are in decreasing order.
Right, but let's say the person who's willing to buy it, and he's willing to pay that much.
So if the person who wants to buy it, he's got to go to the person that's willing to sell it. These are the people who are willing to sell it.
Right, but what you said, you made a statement that essentially said that the person who comes in and wants to buy it is going to buy from the top person in the list. The top person in the list wants to sell it for the maximum amount of all sales.
No. On the selling side,
Okay.
1992, 1993, 1994. So this queue, the S queue is ordered, is a priority queue, okay, for us computer scientists, down and ordered by price where the min price is on top. The bid queue is a priority queue ordered with the max price in top,
Makes sense.
okay?
If there is a gap between the bid price and the ask price, will it sold according to the ask price or the bid price?
Okay, so the first question is, if there is a gap, your question was, if there is a gap between bid and ask, by definition there has to be a gap between bid and ask. Because if not, these guys will already be mated with each other. Okay? So these are people who says, I will sell at this price, I will buy at this price. The purpose of an exchange is to match these people. Okay? If
the stock will be deal exactly at the same price.
If somebody in here said, I will buy it at, if somebody now said, I will sell it at $90.89, his order will pop immediately in the queue and instantly match this person. And this person, let's say you suddenly say, I'm willing to sell 500 shares at $19.89. What's going to happen? That goes into the queue. The top of the queues match. Your sale will get executed immediately, and the outstanding order will get decremented from 1,077 to 577. Okay, reflecting that sale takes place. So the purpose of an exchange is, okay, or one of these electronic exchanges, is to maintain this queue of buy order, of these limit orders, okay, which will buy or sell at particular prices. Then, if somebody comes in and says, I am willing to sell at a price that is above, let's say somebody says, I'm willing to sell at $18.87, lower than the top price on the queue. The exchange will have some kind of a rule about what kind. Clearly, there can be a deal. He's willing to pay $19.89, and he's willing to get $19.87. There is a match there to be made. The rules of the exchange will have to decide what the price of that deal should be. Perhaps they will meet in the middle. Perhaps this guy gets it. Perhaps that guy gets their price. Okay, but those are the rules of the exchanges implemented in the matching algorithms. Okay? The important issue is that if I have these queues, okay, in principle, nothing is going to happen now until market orders come in. If I say buy it at, I want to buy the share at its current price, this is the current price. If I want to sell it, this is the current price. And the difference between the bid and the ask price is what they call the spread. Okay? And it's the, somehow the uncertainty, if you wish, about what the right current price is. Okay? In principle, the right current price is somewhere between here and there. Okay? Any questions about that?
So you mean when there is, okay, so in your example, 1989 and 1987,
Yeah.
So there is no mechanism to determine the price.
Well, you mean there is a mechanism. I mean, what happens if I'm willing to sell for less than the guy is willing to buy? Right? That. Well, the answer is that price is going to be a rule of the. In that case, that's a rule of the exchange issue. Okay. Somehow that there is in the policies governing that exchange, there will be a question of, does it go to the guy who had the order in first? Is it the midpoint of those two? If I were writing the code, I'd say it's the midpoint of those two. But clearly it's a well-defined question. In the rules underlying the exchange and how it works, that will be specified. And the job of the matching algorithm is to constantly monitor the top of these priority queues to see if there is an overlap, to look for new orders as they come in and match them with what's supposed to happen. Okay? Any questions? Now, what's fun about this is if you sit there and watch it when the exchange is open, you can see the orders bubbling around. Okay? You can see that, first of all, the size of the orders here are not representing each a different person, but it's representing all the orders that are in at that price. Okay? If I decide now I'm willing to sell Microsoft, buy Microsoft at this price, and I add my 500 shares to it, well, that would increase the size of the position. But implicitly, there's a tie to be broken. Okay? There's some people who had their sell order in at this price ahead of me. The matching algorithm is going to match things in order of the time that you got your order in. So if I'm willing to sell at a price and you're willing to sell at the same price, if your order came in first, your order would be matched first ahead of me. Okay? I guess principles of general fairness. Okay?
Is that, what about if, say my order, somebody wants to buy 1,000 shares, and I want to sell 500 shares at a certain price, and somebody else wants to buy 1,000 shares at a certain price, or also match on the basis of the share numbers?
So then these now again would depend upon the rules of the exchange. So there's a certain amount of this is sort of the rules of the exchange. The question would be, if I wanted to buy 2,000 shares, okay, is it that I would, get my first 1992 at this price, and then my remaining 8 shares at this price, okay? That would be a logical order provided the people who put in their sell orders were willing to sell part of their shares instead of all of their shares. And presumably there's some way of either specifying whether they're allowed to do that or not. Okay? It would depend upon, presumably, the exchange. So one possibility would be that if I want to buy 2,000 shares, if I'm not allowed to break up orders, it might be that I'd have to go now, march down this thing and match this price. Okay? Any questions here? So there's a question again, which is the way that the particular exchange would match these things? And this, I would argue, is governed by the rules of the exchange. But the basic principle is of there being an order book, okay? And that being how prices are matched should be a universal thing. Okay? Any questions? But what you're asking are good questions in the sense that if I were really a sharp trader, the rules of exactly how you implement this makes a difference. For example, if I am a privileged kind of a broker, am I allowed to cut ahead of somebody else on the queue? Remember we said that there were a bunch of 1992 orders. There were probably 4 or 5 different people who were willing to sell at that price. The question of whether or not if I'm a super enough broker, if I'm the guy who owns the exchange, can I cut ahead of you? Okay, certain exchanges might permit that, certain exchanges might not. Okay? If you're an investor, it's, a small investor, you wouldn't want other people to be able to cut in price in front of you. Okay? And so there's certain levels of rules that have to be resolved, but the basic principle is there's a queue of buy orders waiting and a queue of sell orders waiting. Okay? And somehow the price drifts. And like I say, it's fun to watch this. I encourage you to sort of go over here, click on Archipelago, and see what Microsoft is doing during the trading state. Because you see the prices bubble up and down. And that, you'll see this guy at 1994 has 992 shares. And they might have been sitting there for a long time. This guy's been put in his order back at 840. Okay? And he's been waiting now, half an hour patiently to try to sell his stock. Okay? And you may be rooting for him after a while because you'll see his order bubble up. But then if there's not enough demand on the other side, it'll price down, and maybe some other orders will cut in ahead of him. Okay? So it's kind of amusing to watch this. Okay? And it gives you an idea of how these trading things actually happen. Any questions about how orders are mated? Okay, yes?
How many prices could be in the queue?
So the question of how many prices, there is presumably a minimum discrimination between other prices. Okay? So in this case, it looks like every share is limited. The smallest division is 1 penny. Okay? Back in like 2000, the New York Stock Exchange went from the smallest discrimination between shares as being 1/8 of a dollar down to a penny. And it looks like here, I could sort of say, if I wanted to sell my stock ahead of this guy, I could make it 1990. If I made my price 1991, I could get ahead of this guy. He's been waiting for a while. So I could cut ahead of him if I bid it at 1991 and offered to sell at that price. But I can't do it at 1992 minus 1991.9999999 because there's ultimately a resolution limit of what looks like a penny. Any questions? Yeah.
Is there any information available from this chart about the type of order? Can I know whether
Okay.
this order is market order or not?
So I guess what I would say is, in this queue, the answer is no. Now, the question of which orders are being displayed in this queue, okay, is a separate question. Okay? So, one thing that is true is that up until the moment you can execute these orders get executed, the person who put the orders in can cancel them. Okay? So one way to think about it is that it's possible that a market if touched order, okay, would be such that if the price hits something and you say I'm willing to sell it at 20. The moment the price hits 20, if my order didn't match, I will withdraw it from here and turn it into a market order. That would be sort of the way that would probably be implemented. Okay? Any questions about it? Okay? So if nothing to watch, it's kind of interesting to see. Last night I woke up, very early to prepare my lecture at the time the market was closing. And you could see the market went down a lot yesterday in the last hour. And you could see these people desperately trying to sell their Microsoft stock, okay, at this point. Here, these guys are feeling pretty confident that they could sell it at this point. But the price dipped to about $19 by the end of the day, okay, and so those guys may not have sold. Any questions about it? Yeah?
There's like a ridiculous, trade order. For example, I bid at a particular, a ridiculously low price, would that order stay there forever?
So in principle, if you scroll down here, okay, there are ridiculously low orders that are in there. Okay, so yes, so I can sort of right now call my broker and say, what, I am willing to buy Microsoft when it hits $12 a share. Okay? And that would be sitting there harmlessly at the low end of the queue. Okay? If I go off to the moon for a year, perhaps I'll come back and find that it got executed. Okay? So there's no mechanism in principle to not do that, except that there may very well be that the broker may say that an order can only sit in the queue for a certain amount of time. But in principle, there's nothing to prevent me from putting in a lowball order one way or another. Of course, it does nobody any good unless it gets executed. Okay? Any questions? And probably depending upon the arrangements you have with the broker, there may or may not be a charge for such things. Okay? For orders that go in that don't get executed. Presumably not in general. But any questions? Yeah?
Could we get this information after the day?
Could we get this information after the day? Well, right now, in principle, I'm getting this information live. Okay? When you watch the this sort of applet with these stocks bubbling up and down, you're in principle getting that information live-ish. Okay? So, you certainly could snoop on, let's say what trades are happening here, okay, and monitor it every couple of seconds and get that information. Okay? So I don't know if that answers your question.
So that means it's difficult for us to use this kind of information to do the analysis.
Okay, so the question that you're really asking about is, to what extent, now that you see this, what you as prospective traders may be seeing your eyes light up and say, wouldn't it be great to use this information to trade? Okay? And in fact, what I'm going to talk about at the end of the class is a project which looked at the extent to which you can use the orders that are sitting in this book to help you make good trading strategies. Okay? So for the purpose of your homework assignment, obviously we don't have you don't have access to that data for homework 2. But if you are a privileged enough trader on a flexible enough exchange, you in principle have access to that information or some level of that information. Any questions? And I say how privileged you are, there's a question of how fresh that information is. When I run my applet, undoubtedly I'm not seeing every single Microsoft transaction that is happening. They're probably refreshing me every couple of seconds, when a lot more may have been going on during that time. Okay? And in fact, actually, I saw that I was several minutes behind last night when it was crashing, when the Microsoft was suffering at the end of the day. Okay? But in principle, there is an order queue there. Depending upon where you are getting your order queue information from, you probably can get it faster than I would get it. Okay, a hedge fund is not getting it from a web browser. A hedge fund is presumably tapping into the right database, okay, directly, and able to get fresher quotes. Any questions? So what do we know about the order book? What are the properties that are interesting? We agree that orders with the same price are prioritized by arrival time. The difference between bid and ask is called the spread. The wider the gap between bid and ask, the less liquid the stock is. Okay? If you really want to be able to trade stocks immediately, you know that the price is going to be fair if the bid and ask is differing by the smallest possible amount. Right? If the difference between bid and ask is a penny, then presumably if you put in a market order, you're getting the right price somehow. If the bid and ask spread is quite far, then somehow it's not, the question of how they decide, somehow the liquidity is tied into the size of the spread, okay? And Microsoft is one of the more liquid stocks, so when you see a spread of a couple of pennies, okay, that's still a substantial thing. And for a less liquid stock, let's say, a very tiny company that's being traded, not too many people are trading it, there's probably a much bigger bid-ask spread on that. Okay. What else do we know? But when you look at, let's say, what was the price that it closed at, that is, when you look at, let's say, the closing price, that was the price of the last executed price. Okay? So there probably are still orders on both ends of the book that didn't get executed that day. When you see the ticker price, that's sort of the last executed price. Okay, and we said that basically market orders get matched with the most competitive one in the opposite book. Orders can be canceled up till the moment that they are matched. And apparently now, because you have these electronic trading systems, large numbers of orders are canceled right at the last minute. Because you could imagine, some flexible electronic hedge fund thing put in an order a few minutes ago to sell at this price. Okay? They're now next on line. If they know they're next on line, and now they don't want it, boom, they can cancel it. Okay? And your ability to do that depends upon how quickly you can interact with what's going on there. Okay? But the faster, let's say the better your electronics, the better your computing infrastructure, the more flexibility you have to do these very, very quick things. Okay? And in principle, you can take advantage of that. Okay? Any questions? The other thing to note here that you don't get on the order book is you don't get the idea of who's placing the order. This is what you would like to know. It would be really great if under the Microsoft sale, you had the idea that who's trying to sell and it's Warren Buffett. Okay? Now you may say, well, that means something. Okay? Or, look, there's somebody, all these orders are from, let's say, collapsing hedge fund, collapsing hedge fund, collapsing hedge fund, collapsing hedge fund. You'll know that there's somebody who's very eager to sell. That's probably going to drop the price down. But that information you do not get from the order book. Okay? Any questions? And so why are these things interesting? Well, one, they give you some idea of what the market sentiment is by where the orders are lining up. Are they lining up on the buy side or on the sell side? Okay? And they also give you some idea as to how you should place your order. Okay? Suppose, let's say, if we come back to here, I really want to sell my Microsoft stock. Okay? Should I price it at, because here I'm going to be buying it. I really want to buy my Microsoft stock. If I look at it, I'd really like to pay about 1982. I am probably better off bidding 1983 because I'd get ahead of this big order for 2,500 shares, right? If I now said, well, I'd like to buy it at 1982, it'd be a little bit cheaper. But now I'm behind this big order, okay? And I may not, so it might very well pay for me to offer a little bit more if I know what is sitting in the queue, okay? Any questions? So I can get her behind or ahead of other people. Any questions? So this is, I think, kind of amusing, okay? And the reason why this is done is now because these exchanges are largely electronic. The vision, again, if you saw old movies of stock exchanges, there were people sitting there yelling, okay, at other people and throwing papers on the floor. Okay, that's what I remember when I was growing up. But now, somehow you have, like, NASDAQ is an entirely electronic exchange. There is nobody yelling at anybody else in NASDAQ. Everybody is yelling at a computer screen. Okay? And all the matches are being done electronically. Now, the thing that's interesting about something like NASDAQ is that there is not one central, let's say, exchange happening. NASDAQ allows these things called electronic crossing networks, of which Archipelago, which we saw, was one of them. They can be sort of viewed as different trading floors, okay? And there's traders working in each one of these little floors. If you decide, I want to go buy Microsoft, you will decide, should I buy it from Island? Should I buy it from Instinet? Should I buy it from Archipelago? And if I go into Archipelago, there's a bunch of people trading back and forth. Okay, there, that's what we were watching. But the prices in one of these networks does not necessarily reflect what is happening in another network. Okay? If in Archipelago I decided, if Bill Gates decided to sell out of his shares in Archipelago only, Microsoft's price would drop there. It would presumably eventually drop in these other ones. but there would be some kind of a lag. Okay? The question of, again, what the prices are on one of these things relative to the other one. In principle, if you've got a fastest computer, you can now do arbitrage kinds of things. There's a slight difference of Microsoft in this, electronic crossing network, ECN, than in this one. Okay? And so that's another reason why many of these things require very advanced technology to try to get the fastest, access to prices is an important thing. And that's an infrastructure thing, a computing thing. Any questions? Again, some of these ECNs, like the ones we showed, show their order books to traders, but this is up to them. Some of these, let's say, I'll call them little exchanges, don't reveal their order book. They're called dark pools because it's somehow a mystery what's sitting on the queue. So if you're a hedge fund and you're paranoid about anybody seeing what your order is, you might want to make your trade on one that is not visible. Okay, if you're afraid the exchange is going to cheat you, okay, not give you a good order, you're probably better off trading with one that is visible. Okay? Any questions? And these electronic networks account for a large fraction, but the number I saw was 75% of NASDAQ trades. Presumably it's higher now. Okay? And that one of these particular ones accounted for like 1/7 of all the trades. So bottom line is that if you're really an active trader, you're constantly seeking the best price. You have to not only monitor this pool, in principle, you should be monitoring all the other pools. And this is why computer trading systems are good things, because they presumably won't get tired monitoring all of these things and moving back and forth. Any questions? One thing that you should get from this idea is that there is a scale of operation of running one of these stock markets or these exchanges that is really a large-scale operation. Okay? When I was looking to try to find out what was the record volume on the New York Stock Exchange, I saw 4 billion shares on one day. Probably that's been broken since, or it may have been broken since. But what does it mean when an exchange trades 4 billion shares in a day? Okay? 4 billion, I mean, how many people are there on Earth? Does anybody know? Okay, there's about 6 billion people on Earth. So it could be that one way to think about it is and if you figure this out, it means there's probably about 4 billion families. So one way to think about it is maybe every family trades 1 share of stock a day. That's probably not the right way to look at it. But the way to look at it is, if the average transaction is on the order of 100 shares, okay, per transaction, which I know happens to be about right. It's a little bit more than 100, but it's not 1,000. Okay? That works out to about 10 million transactions during that trading day, which was about 6 hours long. And that worked out to me to be about 500 buy-sell, 500 transactions, 500 matchings happening per second, okay, to keep this market going. And of course, there are other markets going. And what's more, so you've got to have it. The point is that there's a tremendous amount of computing and network infrastructure in this business. Okay, that's the important thing to see here. A lot of the stuff that we've been talking about this semester, maybe you'd say, oh, it's the mathematics, or oh, it's business. The important thing to see here is this is where the computer scientists are traditionally appearing in the hedge fund world, in the finance world, is on the infrastructure side, because these are very sizable things. Okay? So if some people have come to me and said, oh, my background is networking, how do I go and get into this world? Well, this is the end of the world that you would want to be getting into. Okay? This is some of the infrastructure issues of how do you run these exchanges. Any questions? Okay? Again, these trading volumes, the other thing is to note that if your system can handle 500 transactions a second, that's not enough, because trade volumes spike when there are difficult times. Okay? They spike at the end of the day. So an average of 500 transactions per day probably means a peak of several thousand transactions per second. Okay? And so dealing with that is an interesting problem. Any questions? Okay. Actually, given time, Okay, let's just talk about this now. So, one thing that you realize, if we're now dealing with trading and making these individual trades and figuring out how as a trader should I work, you have to be aware of transaction costs. Transaction costs, you know, if you ever bought stock, you may be aware of, because your broker either will charge you a fixed fee, okay, saying I will charge you maybe $1 per share that you trade, or I may charge you 1% of the value of what you're holding, or typically it's much less now. But when you look at the costs of actually doing stock trading, the full picture of costs is substantial, and not just these fixed fees. That's what the thing to realize is. When you look at these things, this was a book I was reading about trading strategies, and what they were saying that the transaction cost in the U.S. ranged on a typical order from, 87 to 134 basis points. What was a basis point? It was 1/100th%. So a way to think about it is, the cost on each transaction was about on the order of 1% of what you were trying to trade. And most of that was not in commissions and fees, okay, or things that are, let's say, obviously visible. What's visible to you? Well, when you buy and sell something, you may have to pay taxes. When you buy and sell something, there are either fixed, per share fees or percentage commission. Okay? Those are all visible. The bigger costs tend to be in how you're impacting the market. One of the things we saw was the spread. That if there's a bid value here and an ask value here, okay, and you want to buy it now at this price, there is a transaction cost. You've got to actually pay. You want to buy it at $20, you can't buy it at $20 because the person who's selling it to you won't sell it to you for less than $20.05. Okay? So either you've got to pay what they want, or you've got to wait and let the prices possibly change. So one possibility is I can say, I want to buy this stock at 20. Somebody may tell you it's now selling at, will sell to you at $20.05. The transaction cost, part of it is the bid-ask spread. Part of it is now the risk. It may very well be that I want to buy this stock because it's going to go up. Well, if I don't buy it now, I put in a market order, maybe between the time my market order gets in and it gets executed, the price may have gone up to $21. Okay? So what we view as transaction costs are not only functions of what look like visible fees, but are these non-transparent fees. Okay? Any questions? And so the traders have this vision that somehow if you trade too slowly, let's say I want to buy a large order, I could say I will pay $20 a share and wait until people will meet my price. The trouble is the price may drift. If I want to buy a large order now, it could very well impact the price by cleaning out the queue of all the people who want to be selling it. And as you remember back from looking at the queue, if I demand to buy this stock now, I want to buy 50,000 shares of Microsoft, I will start paying this price. But for these shares, I'm going to have to pay $22 a share. Okay? So the trading issue is sort of, when you think about, let's say, monitoring priority, the transaction costs, you have to factor in both of these factors to come up with a right strategy to execute what you want. Any questions? So I don't think I'm going to go into this more, but too much more. But basically, there are interesting models of what it is, the transaction costs you will pay depending upon what strategy you use to sell. Okay? There is a cost, like in this model, they break it down into sort of a couple of different factors. One is there is a delay cost. If I decide that I want to buy Microsoft now at $20 a share, there is a certain delay cost because by the time I pick up the phone and call my broker and say, buy it at $20, the price will have drifted. That's somehow what this is measuring. Then there are trading-related costs. At the time I finally got my order in, I wanted to buy it at price P0. It may be that as I break it down into a bunch of different orders, some of my orders will be more expensive than that. And there's going to be some trading costs. There is also what we would call the opportunity cost. And this has to do with when the profits you didn't get because you didn't get to buy it. Let's say that I insisted on buying, I wanted to buy this stock at $20 a share. Okay? And I wouldn't pay more than $20 a share. But the price immediately goes up to $21 a share. I didn't buy any of it. So you might say I didn't have any costs. But actually I did lose $1 a share on this that I could have made if I had gotten my order in. And that's kind of what they're trying to capture by opportunity costs. Okay? Any questions? There then are models to show, though, if I put in an order saying I want to buy 50,000 shares at the market price, what the impact of that is going to be on the price. So you would sort of expect that if I'm going to put in a big buy order, that's going to cause a change in the price temporarily because of the balance between supply and demand. Okay? And, you know, there are models, in this case, where the impact sort of decreases exponentially. Okay? If I put in an order now, how much of an impact will it have on price? A minute from now, 10 minutes from now. But the interesting thing is once you can model what these trading costs are, then in principle you can design a trading strategy. If you want to move a certain amount of stock, how you should actually do it. And this is one of the, let's say, less glamorous things that a quant would do, but a very important thing, okay, to try to implement these kind of optimal trading strategies, okay, so as to get the best prices on everything they do. Any questions? On the homework, you guys didn't pay any transaction costs or any visible ones, but it makes a difference here. Any questions? So, for the rest of the time, I'm hoping, okay, what I want to talk about is a computer science-oriented project to try to get a handle on how trading strategies work. Okay, these micro trading, for the microstructure market type trading strategies work. So Michael Kearns is a famous AI person, very reputable computer scientist. Luis Ortiz is a reputable enough computer scientist. We hired him at Stony Brook for a faculty position. And they built a project about 5 years ago to try to analyze what, you know, to try to come up with a simulator for studying how you would work out trading strategies. Okay? And the issue here is really has to do with things like impact. You are, in the marketplace, if you are a trader, you are competing against other traders for these stocks. Okay? And they have their own strategies and you have your own strategies. And if you really want to see how a strategy works, in an ideal world, you would bet money on it and see what happens. The trouble with betting money on it, of course, is that if your strategy is bad, you have lost that money. So it's expensive to learn how a strategy works by actually betting money. On the other hand, simulating it, simulating it from static data, like you guys did for homework 2, does not paint a full picture of it. Because you'll have this vision that, yes, I can buy an infinite amount of it at the closing price. And that's certainly not true. Okay? You're not factoring in, so you may say, I'm going to take advantage of these very small differences between closing and opening. Well, you can't always get the closing price and you can't always get the opening price. And so how do you factor this thing in? The other thing that this project was trying to do was to look at to what extent you could use the order book to try to place orders. So what they did was actually, in my mind, kind of clever. What they did is they built a system that combined real data with real price data with simulated orders. Okay? That every 3 minutes they would go over the web and get a look at that order book that we said. And that showed you what stocks prices were in the order queue, what trades there were. To show what you could do, if you placed an order in the simulated world, they would keep track of a mix of the real orders that were sitting there, okay, in this, in the real exchange, and the simulated orders from the different trading agents, okay, and this simulator would basically provide the matching on this queue of real orders and simulated orders, okay, and so you can see sort of how you get affected by that. Any questions? I don't know if I explained that clearly. Yeah. Yeah.
But the real order book doesn't really take these simulated orders.
Right, so what would happen here is, you're right, that here is the real world, busily trading Microsoft, all of it. Every once in a while we look at it and see what the current orders are, and we inject our own orders here. You're right that some of the other things are going to be going on here, and we won't see them. And if we decide to place a big order, it won't impact the orders that are out there for Microsoft, but it will impact the prices that we're seeing if I'm competing against other agents. So the thing that the idea here is this: as a simulator, it's not just that I'm trading against the world. That's one way I could view it. But then you're right, if I put in a huge order here, okay, it wouldn't depress the world's prices. But if I have a bunch of simulated trading agents working at the same time, it would depress the prices here, because these guys are now going to also have orders in. And in order for it to match it, I'm going to be matching it partway through the regular queue and partway through these other orders. Okay? So these other trading agents provide a way to keep me somewhat honest. Okay? Any questions? Yeah.
However, does it consider the interaction between the investor and simulators? For example, if other investors see that there is a very large volume issued by your simulator, and then their reaction may change and overreact.
So what we're saying here is that we're seeing there's real traders in the world doing these things. There's simulated traders I'm competing against here. And what the argument is that with this, in the simulator world, I am competing somewhat against the real traders, okay, and somewhat against the simulated traders, okay? That you're right, that if I place a big order here, it will not affect this queue, but it will affect this queue. And because I have other agents watching the queue, it will affect the prices here in a reasonably sensible way. Any questions? In an ideal world, I would have money to play with and buy Microsoft stock and affect this other real queue. But that's not generally that's an expensive way to learn. It's an expensive way to do research if I have to trade real money. But if here I can infuse real orders with simulated orders, I can get more realism than the kind of backtesting environment that you had. Okay? And that's sort of what they were trying to achieve. Again, we talked here about backtesting environments. Backtesting means evaluating performance on historical data. That's what you guys are doing in homework 2. Okay? If your simulator uses price but not order data, you don't study market impact. Okay? And that's the limitations of what you're doing in the homework. In principle, to do a good at backtesting, you need to have a long stock history that you can run it on. But of course, trading strategies for long history are not necessarily, you can't necessarily study them in backtesting on long histories. Because, the world has changed. Before 2000, the bid-ask spreads were a lot larger before they decimalized things. Before they had these electronic crossing networks and they became so important. Certain strategies might have worked because there was less liquidity than before. Okay? So part of what these guys will do is backtesting. Part of what they will do is out of sample testing. They will say, oh, I think I have invented a great strategy. I have the backtesting results to show I will make, 5% over the market rate. Okay, if you use this strategy, what they will then probably do is then do in-sample testing. They'll then wait a few months and do a simulated trade on the new market data as it comes in, and see if your data really holds up, okay, before actually employing it. So a lot of the efforts that go in at these hedge funds and things like that, these trading strategies, is in evaluating strategies, and there are subtleties there. Any questions? So how did Penn do this competition? Because I think it's kind of interesting. What they did is they held a series of competitions using their trading simulator. And they invited all university groups to compete on their marketplace. What they did is they limited trading to one stock, which was Microsoft. Said you could buy and sell Microsoft, and that's all you can do. And this represents, really micro trading kinds of things. Okay, there are undoubtedly people who spend their lives looking at Microsoft price, moving back and forth, and that's what this one is doing. They said you could never own or short more than 100,000 shares of Microsoft at one time. You have a budget, okay? And Microsoft was then about $25 a share, so that meant that you could go either high or low. You could have $2.5 million at risk. What they did was they divided their entrants into two different pools, because somehow these entrants are really trading agents. And the problem is, if you have few trading agents, you can make big swings and not affect the world. If you have too many trading agents trading too much simulated money, they're going to overwhelm, let's say, the other real data that's being on. So to limit things, they limited each pool to about 7 contestants, and they ran it for 10 business days as this competition for each one of the strategies. Any questions? They awarded points to a trader based part of it was how much money they made. But hopefully now you'll see that there are more subtle points here to evaluate a trading strategy than just how much money you had made. Because there is a question of how much risk are you exposing yourself to. Remember, we talked about risk returns and portfolio construction. Saying I made a return of 10% doesn't mean anything unless it's a function, let's say, parameterized by risk. So they graded their trading agents on several different things. One was profit, the daily amount that you won and lost. One was how consistent was it. Okay, a trading agent that made $1 million one day and lost $1 million the next day was deemed a less good good trading strategy than one that just sort of broke even every day. Okay? They gave you points for reversing your position in the day. One kind of trading agent might have been buy Microsoft at the beginning, 100,000 shares, and walk away for 10 days. Okay? Now that's not a very actively managed strategy. What they wanted, they thought a good strategy would be one that would both go long and go short. And so they gave points to encourage that. They gave you points for being insensitive to the market. If you made money on days the market went up and the market went down, that presumably is a better strategy than one that is a more market neutral strategy than one that just made its money when the market went up. Okay? They gave points for what they said risk saturation. Okay? If you had permission to buy 100,000 shares, okay, it would be a not very good trader that never took advantage of the amount of capital that they had. Okay? So they gave you more points if you actually did achieve a large position each day. Okay? Because in principle, one of you was telling me, oh yes, my strategy made more money the more it traded. Well then in principle, a trade, if you have a budget, if that's the case with a strategy like that, the more you actually spend, okay, the more you actually use of your position each day, the better off you are. Because if not, someone should take that extra money from you and not let you invest it any. Give it to someone who will invest it. And they give you points for daily position unwinding. if you're in this world where you're trading during the day, you have a world where most people want to buy at the beginning of the day and sell by the end of the day. So you're not exposed to risks at night. Over the night, something bad might happen to Microsoft. You sleep better if you're out of the market, if you're really a short-term instant trader. And so you would like to move all your position out every day, but that may not be possible without really adversely affecting prices. This, by the way, is why prices often drop at the end of the day. Is that everybody's trying to get out at the end of the day. Like yesterday, prices dropped a lot in the last hour. The reason is because everybody wants to get out, so they're not exposed to the risk overnight. So all this is real criteria. They did not explicitly charge transaction costs. So there was no problem for you making lots of little trades. Any questions? So there were a bunch of different strategies. There were 14 different strategies that were employed. Many of these, most of them, looked at the order book imbalance to try to make trades. So they took a look at, they said, here I've got in this order book, at this price I'm willing to sell this much, at this price I'm willing to sell this much. They would compute what was the average amount of money trying to sell versus the average amount of money trying to buy. You can compute a price, there's a dollar volume, let's say a right price, which is a function of how much orders are in the book at what price. They would compute some kind of an average based on this. And then depending upon whether the average for where you would want to buy versus the average you want to sell is higher or lower, they would use that to decide, gee, if there's the amount, let's say the price that will get people to sell is here, and the price that people will buy at is here, well, that probably means that the price is going to go down, because it's going to have to go down in order to reach these people, okay, who have the other side of the liquidity. Okay? Any questions about that? That's sort of the idea of using the order book that we talked about a minute ago. Some of them use machine learning techniques, some of them use technical indicators. Another class that was interesting was what we would call the market-making strategies, okay, which were a lot like the pair trading strategies. If instead we have a current price here, this is the price of our stock, maybe I will agree to sell it if it hits this price, and I will agree to buy it if it hits this price. So I will put some kind of a window at regular moments in time. I will make compute an upper bound and put in a sell order for then, and a lower bound and put in a buy order then. The hope would be that the price is going to wiggle around. It's going to wiggle high enough that I actually sell it, and then wiggle low enough that I actually buy it, and if so, then I would make the profit between them. Okay? Where I would lose with this kind of a strategy would be, suppose every few minutes I put buy and sell orders in at a time that the price is dropping. I'm going to end up buying large amounts of the stock, but never selling it. You see what the idea is? Somehow what I would want to do is if I put upper and lower bounds on it. So sold it here, bought it here. If the price wiggles up and down enough in this range, hopefully I will collect a profit each time it wiggles. I lose if the price goes into free fall, then I've got too much of a position on one side. Okay? And that is potentially a bad thing. Okay? Any questions? And then, I have to decide what price would I buy and sell it at. And there's different variations. We could say 1% above or below the current price. Or what I kind of liked was one that said, we'll put it immediately, our order immediately in front of the nth order in the book. Okay, so we cut off, other people from that. Any questions? So if we go through this, there were lots of different strategies. Who were the winners? The winner of one of the pools was one that was one solely on the basis of profitability. This is one that sold whenever the volume-weighted price average of the buy book was further than the last price from the last price than that of the sell book. So again, they computed the statistic that was, here is the price, here is the volume. I compute the weighted average on one side, I compute the weighted average on the other side, I see what the last price is. Okay? I use this to sort of suggest, is there going to be an upward or downward trend on it? And I aimed based on that. Any questions about that? That was the most profitable, the winner in one of the pools. In the other one of the pools, was actually the winner was a strategy that was hardly profitable, but it always obeyed good trading practices. Okay? It always unwound its position at the end of the day. It always, bet all the money that it could bet. Okay? It didn't have much risk. Okay? And so by the point system, this trading strategy did better than the other one. In that pool was a trading strategy that was of a similar flavor to this. This was a market-making strategy. But it didn't do a good job of spending all of its money, and it lost points there. Okay? Any questions? So here was an example of what the trading outcomes were like. And as you can see, some of them showed an average of profit of $4,000 per day. Some of them were negative. Okay? But you can see different strategies scored different dimensions, of course, different dimensions. Okay? And again, the problem, what is the best trading strategy is not a simple question of profit, but is, a more complicated thing. The more complicated one that we talked about in here was the Sharpe ratio, the ratio of the returns to volatility, and the best strategies did best according to those measures. Any questions? Okay, I think I'm willing to end it at this point. Any questions about the simulator or how you would do these kind of games, or how these kind of program trading systems actually get written? Any questions? Okay. Any questions about homework 2? Okay, we'll leave it like that. Any questions about the project?
Yes.
What is your question about the project? Okay, so the question of when the project is due. I will now put this to a vote, but I want people to understand what the issues are, because the obvious answer, people's realistic reflex reaction is to immediately demand a delay, okay? And this is why people go further into debt, right? You have a credit card, right? How many of you have credit card balances, right? The credit card company is always willing to let you wait longer to pay it back because they're adding interest, okay? And you get punished for that, right? Recognize what the constraints are. The constraints are that you have a final exam, which is on December 16th. You have, I think it's the 16th. Am I right about that?
Yes.
Yes. You have a end of semester thing. The project could be turned in on, let it be Friday without problem. That would be December, what is it? Friday would be is it the 5th? Okay. Now the question is, the project was worth 20% of your grade. The exam was worth, does anyone remember? 35% of the grade. What would be a bad strategy? A bad strategy would be to say, oh, I am going to spend my time doing the project so I get a really good project. Okay? A better strategy is to use this time, is to realize this is akin to not that much different than a homework assignment. And to say that I'm better off getting it out of my system. Okay? Any questions about that? Yes?
Actually, it's possible for us to submit the project on 18th. Yeah.
On the 18th, the answer is no. It'll either be at the final exam when you walk in, or on Friday. Okay? Those are the two possibilities.
Actually,
Yes.
what should we submit, including the source code and reports, right?
You would have to email me things and give me a printed report.
Only reports, yeah.
Well, and you should put on the web where I can get access to everything else if you have it. Okay? So either mail me the files also, or tell me, give me a link where I can get it. I want to be able to read a printed report, and I'd like to be able to see what you've actually done if it goes any further than that. Okay? Any questions? I'm now going to turn around. I'd like you to be my counter. Okay? Who wants to be my counter? You're my counter. Okay? Who here would like me to say that you can turn it in on Friday, but no later than Friday? Okay, to make sure you stay clean. So raise your hands if you would like it turned in on Friday. Okay? Is that counted now?
Yes.
Okay, who here would like to say, I don't care about the exam, okay, I want a gun for it, okay, I want you to turn it in right before the exam, okay? Who here wants that? Raise your hand. Okay, who here does not want that? Okay, you feel you have the count now?
Yeah.
What is the vote?
0 to 6.
What?
0 to 6.
0 to 6, meaning 0 said this, and 6 said this? Okay. I would love to be in the business of selling you guys credit cards. That's all I have to say. Any questions? Okay? That said, fine. Turn it in. You can turn it in. I need to see a printout on the day as I walk into the final, and have emailed me a link to your other files and other things. And we'll talk more about that next class, just to make sure. Any questions? Okay. Thanks for your attention. Talk to you guys next class.